The year 2026 began with warning signs few were prepared to acknowledge. Technology stocks plunged, venture capital froze, and major indices began showing patterns reminiscent of the 1929 crash. Analysts called it a correction, but behind the numbers lay structural weaknesses threatening a full-scale economic collapse. This was not a single-sector problem. It was systemic, affecting credit markets, consumer spending, and corporate debt simultaneously. Overvalued tech giants were the first to signal distress. Companies that had dominated markets with promises of AI, cloud computing, and electric vehicles suddenly faced slowing growth, regulatory scrutiny, and supply chain bottlenecks. Investors, who had poured billions into these companies on the expectation of perpetual expansion, began selling aggressively. The resulting stock declines created a cascade effect, triggering margin calls and automated trading algorithms that accelerated the fall. Corporate debt exacerbated the situation. Many tech firms had borrowed heavily during low interest rate periods, expecting continuous revenue growth. When earnings projections failed to meet expectations, bond prices fell and lending conditions tightened. Banks and investment funds, exposed to these debts, reevaluated risk, reducing liquidity and slowing capital flows. Startups, dependent on fresh financing, faced abrupt shutdowns, adding further stress to the tech ecosystem. Consumer confidence began to erode. As tech layoffs became public, households reduced spending on both luxury and discretionary items. Retail, travel, and entertainment sectors felt the immediate impact, contributing to declining GDP projections. The economy's interconnected nature amplified these declines. Weaker consumer spending reduced corporate earnings, prompting more layoffs, creating a self-reinforcing downward spiral. Global markets reacted in tandem. The U.S. dollar, while still dominant, faced volatility against other major currencies. International investors pulled back from U.S. equities, further pressuring the stock market. Emerging markets linked to American tech supply chains experienced disruptions, slowing growth worldwide. What began as a domestic tech correction rapidly evolved into a global financial tremor. Asset inflation, previously fueled by quantitative easing and low interest rates, reversed sharply. Real estate markets cooled, cryptocurrency valuations collapsed, and commodity prices became unpredictable. Wealth concentrated in the upper tiers of society faced temporary volatility, but the middle class and retirees relying on market-linked savings saw sudden erosion of financial security. Confidence, once the foundation of economic stability, became the first casualty. Policy responses were slow and reactive. The Federal Reserve and Treasury attempted targeted interventions to stabilize credit markets, but uncertainty overwhelmed action. In financial systems driven by expectation, anticipation matters more than reaction. By the time policy measures were announced, investor panic had already accelerated, reinforcing selling pressure. The warning signs were clear. Over-leveraged companies, inflated valuations, weakened consumer confidence, and fragile international connections created an environment primed for collapse. What many perceived as isolated shocks were in fact premonitions of a deeper economic reckoning. The seeds of the 2026 downturn were embedded in the architecture of modern finance, not in any single event or policy failure. The second phase of the 2026 economic collapse involved cascading systemic failures. Banks exposed to corporate debt faced sudden liquidity shortages. Interbank lending froze as institutions feared counterparty defaults. Major financial hubs saw credit spreads widen dramatically, creating a chain reaction. Companies that relied on short-term borrowing could not finance operations, and even profitable firms struggled to meet payroll and contractual obligations. Investor psychology intensified the crisis. Fear spread faster than facts. Media coverage highlighting plunging tech stocks and layoffs fueled panic selling. Hedge funds and automated trading systems, programmed to react to volatility, amplified the downward momentum. Individual investors, witnessing billion-dollar valuations vanish overnight, rushed to liquidate positions, further deepening market declines. Global supply chains compounded the problem. Technology hardware and semiconductor manufacturing concentrated in a few critical regions faced disruptions. Shipping delays, regulatory restrictions, and energy shortages delayed production timelines, causing missed deliveries and missed revenue projections. Tech companies' dependence on these fragile networks revealed the vulnerabilities of a highly interconnected global economy. Corporate earnings reports that once excited markets now triggered fear. Even minor profit warnings were interpreted as harbingers of collapse. Analysts revised growth forecasts downward, causing more margin calls and forced asset sales. The negative feedback loop intensified, creating a self-reinforcing cycle where the perception of decline became as impactful as the decline itself. Public sentiment also shifted sharply. Consumer confidence indices fell to historic lows. Spending on non-essential goods declined, savings rates spiked, and unemployment fears forced households to tighten budgets. Retail, travel, and service sectors, heavily dependent on discretionary income, suffered dramatic contractions. The slowdown in consumption further pressured corporate revenues, amplifying the financial spiral. Government and central bank interventions provided only temporary relief. Stimulus measures and emergency rate cuts helped stabilize liquidity, but could not counteract the psychological and structural elements driving the downturn. Policy lagged behind market reactions, illustrating the limitations of traditional economic tools in an era dominated by algorithmic trading and hyper-connected global markets. By mid-2026, the U.S. faced the unmistakable signs of a tech-driven depression. Stock markets had retraced years of gains, venture capital had evaporated, and major corporations were restructuring or downsizing. The economic landscape had shifted from growth to contraction, leaving policymakers, investors, and ordinary Americans to confront the consequences of years of overleverage, speculative investment, and systemic fragility. The collapse was a wake-up call. Modern financial systems, while capable of immense growth, are extremely sensitive to interconnected shocks. Technology, once seen as a stabilizing force for the economy, became the epicenter of systemic risk. The 2026 downturn revealed that overconcentration, high leverage, and global interdependence could transform market corrections into widespread economic crises, leaving millions exposed to financial instability and uncertainty.